Good morning, everyone. Happy Labor Day to all of you in the US. And for those of you from Singapore, happy Monday and good luck for the rest of the week. Morning, Sagik, or the company that you've been asking me to cover. While we're waiting for people to come in, why don't you just tell me like what is it about this particular business that intrigues you? And do you actually have a position in it? Happy Labor Day, happy Labor Day. So is this a bigger position for you, or is HIMS a bigger position? Oh, I agree that they have many more verticals for sure. Um, yeah, well, because the member growth, fast, actually, I think it's all right because when I was looking at the numbers, I'm not too sure whether I'm understanding it correctly, but it seems like every single year they're only growing at around 20 over percent compared to some other companies. Yeah, so we'll touch on the insurance portion as well because I think that was one of the reasons why their revenue actually got hit this quarter because of some of the refunds from insurance and all that. So this was quite an interesting company for me to research into because I think there are quite a few parallels to HIMS. Yeah. How long have you been in this company? Because when I went to take a look, I realized there was a period of time where they were trading in the $1 to $2 range before the GLP ones actually became a thing for them. Oh, okay. That's quite a decent cost basis. I think on a valuation perspective, I mean, especially if you take a look, they are like a $290 million company. It's a pretty small company. I think they're a small cap company. They have around $36 million in cash, right? So more than 10% of their market cap is actually in cash. So I think, I mean, with that cost base, I think at least from a valuation standpoint, it's fine. I think with LifeMD, because they are a much smaller company, uh, I don't usually invest in such small companies. So, there are certain things that perhaps because of what I'm looking at, I'm actually a little bit more uncertain about LifeMD than HIMS. I'm actually more comfortable holding HIMS than LifeMD right now. Later on, I will explain why. And then yeah, because like I said, this is only a company that I have looked into perhaps in the past week or so. Uh, yeah, and then I think because of that, um, maybe my depth of knowledge is still, or not maybe, definitely my depth of knowledge is still not as deep as some of you who have held this company for a while, because I'm sure I've seen this name come up a couple of times in the comments, at least 3 or 4 times by a few different people. So I'm sure there are people here. Uh, yeah, I wouldn't invest in it in of him. It is a vertical in the healthcare space, for sure, because I do think there are differences over there. So I think okay, it's around 5 minutes. There's around 7, 8 of you here. So let's begin. Just give me a moment. Let me set everything up. And I think at the end of this whole live stream, I'll also be talking about what to expect from the channel going forward in the next from the next couple. Oops, sorry, for the next couple of months. Yeah, just using my phone to make sure everything is. All right. So today is day 10 of basically covering 10 companies in 10 days. So we have basically reached the final day. It has been, a very interesting journey for me. Challenging myself to learn how to conduct a live stream. I think every single day I'm learning something new about having to multitask. And for all the people that I'm sure you guys have followed, from the past, if you follow people like meet Kevin all the way to Amit and even Tanner, yeah, I think they make it seem much easier than it actually is. So, it's a lot of fun learning how to multitask and run the stream together. And actually also to take the opportunity to look at companies which I otherwise wouldn't have looked at, right? So the company today that we are covering is called LifeMD, or ticker symbol LFMD. Now I'm going to be doing something different rather than just look at the company, because later on when we go through the valuation, I want to put them side by side with HIMS, which is also another company that they have often been compared to. I think if you were here earlier on when I was speaking to Sergey about HIMS and LFMD, I don't think these two companies are that comparable. Why in a, but I think for me, I think it's something that we need to address, because I see a lot of discourse, at least on X and on YouTube comments, comparing these two companies. So I looked at the numbers, and I think, yeah, personally, I think I just want to begin by just giving you the long and short of this company, right? I think how I think about it, I would actually classify this company as a little bit more of a stretch for me as an investment compared to HIMS. I think they are a much better stock than a business, which means that I think that they are, in terms of valuation, definitely fairly priced. But in terms of their businesses, I think there are certain things, because they are so small, that I would like to see before I become a bit more confident in investing in this company. But of course, I'm also aware, like I said, I've only spent about a week or so looking into this business, and I may be missing some parts over here, right? So I'm going to be pointing out what I like, what I don't like about the business. If there's anything that I have mistaken, please feel free to let me know down in the chat, and then I will do my best to multitask, reply you, and continue with this at the same time. So I think I need to start off by giving you the framework that I have when it comes to investing in companies. Now, I know the general definition: companies smaller than 10 billion are not considered smaller cap companies. Those are already mid cap companies, but I think $10 billion and under, companies in that range, which I have tend to invest in, companies like SoFi, companies like Palantir, and so on and so forth. I think for these kind of companies, I believe the founders, the founding story, the management team is also an extremely important piece to the puzzle, because it is really not easy to run a business, right? So if your vision and your mission is not clear to investors, to people out there, then I do think that it is easy to become outcompeted. Now I'm saying this because the story of this company sounds rather opportunistic in nature, rather than mission driven, and for some people that makes sense, because some people view this as the management team being very in tune with current trends. Some people may view this as being too quick to pivot from one kind of business model to another. I haven't really exactly made a decision exactly where I fall. I do say it feels a little bit uncomfortable, but after I felt more uncomfortable initially when I was just looking at the numbers, reading through the 10K and so on and so forth. But after listening to the interview, I felt a little bit more comfortable with this. So I'll take you through my whole thought process and how I arrived at the conclusion that I arrived at. So you see, LifeMD, for those of you who are perhaps new to this company, if you did not know, they are not a new company. Technically, they were founded back in 1994. Now, the initial name of the company was Immune Inc., and their main business basically centered around developing and manufacturing certain health products. I can't remember the medical name of it, but they basically positioned themselves as a biotech manufacturing company within the supplement space, right? Okay. So thereafter, in 2016, I believe they acquired this online marketing division, trying to help them sell their own products. Now, subsequently, because of how successful this online marketing division became, they decided to divest away from their manufacturing business as the online marketing division grew. Right. So basically, they made the decision in between 2016 to 2018 to basically pivot and focus on their direct to consumer, healthcare, and e-commerce. Now, this entire transition fully took place in around 2018, early part of 2018, or early mid 2018, because they felt the online marketing segment offered a higher growth potential, better margins, and ability to scale. So in 2018, as part of this transition, they changed their name to Conversion Labs, and they had a new ticker symbol, CVLB. So at least this was what we are told about Conversion Labs, right? Conversion Labs is a technology-driven e-commerce company that built innovative and proprietary brands. So the company leverages the world's greatest social media, search, and e-commerce platforms to rapidly and profitably grow. So they are basically selling healthcare products, helping other people build brands, and themselves to build their own healthcare brand as well, and continually expanding. We are in the rise of e-commerce, and we believe that Conversion Lab is in a strong position to take advantage of the to take advantage of the shift towards online marketing, right? And so this rebranding symbolizes our company's transformation to become a leader in online direct response marketing. So they were a marketing company, and then they were a biotech manufacturing company, and then between 2016 and 2018, it was a period of conversion where they became an e-commerce marketing company that sells healthcare products. Now, the CEO, his name is Justin Schreiber, I hope I'm pronouncing correctly, said this during the interview. He said that when CVLB, Conversion Labs, was first founded, we have invested heavily over the past 2 years to build what I believe is one of the best online marketing teams in the world. Now, we intend to aggressively grow revenue, launch a variety of new products, and uplist the company to a national stock exchange in 2018, which they did, right? I believe. Otherwise, they wouldn't have the ticker symbol CVLB. Anyway, so this was back in 2018. Now, within 3 years, in 2021, because in 2021 they felt like rather than just sell healthcare products, why not build an entire healthcare platform? And so it's this second transition over here that initially got me a little bit concerned. Now, some people may view this as they are being very shrewd and opportunistic in nature. Some people may view this as being too quick to pivot. Like 2-3 years ago, they saw the opportunity in e-commerce, and then because it was a large growth potential, and they felt like Conversion Labs was best positioned to do well in the e-commerce space. And then 3 years later, now it's become the next big market that they see is healthcare, and then now they think that LifeMD is positioned to actually do well in the healthcare space. So this conversion or this pivoting from one segment of the market to another may be concerning for some. I think I read a couple of different arguments for both sides. I think generally, if I were to sum it up, I would say that people who support this thinks that it's important that a CEO understands the market that he's in and is nimble and is able to shift the company in a way that actually suits what the market is or what is in demand for the market. And for people who are more skeptical, feel like if a CEO is really that good, they should be able to find ways to navigate around this. For me, why I found this uncomfortable at first before listening to his interview is because, you see, e-commerce isn't something that just died between 2018 and 2021. In fact, e-commerce boomed during COVID. So it wasn't because e-commerce didn't do as well. The market for e-commerce started to dwindle, and that's why he shifted to health. So personally, I didn't really understand the drive behind this shift. I think e-commerce is an equally huge and scalable market if done well. Healthcare is the same. So personally, for me, the reason why I felt a little bit uncomfortable at first is because I didn't understand the reason behind this switch. Because now, They are they were a biotech manufacturing company. Then they acquired a marketing platform, became a marketing and e-commerce company, and then now within 3 years they are back to healthcare sector, becoming a healthcare platform company. And I think, of course, investors' concern is that what is stopping them from chasing the next shiny object when competition starts to heat up, right? And then there's another new vertical or new market out there that may give better opportunities to scale. But I think so far, my experience is that from the CEOs that I have experienced, that I have invested with, they tend to be so deep in the market that they're in, such a broad depth of understanding in the market that they're in, that they're able to see opportunities within that market that other people can't. Think about people like Alex Karp, Anthony Noto, Elon Musk. They're able to see things within that market itself that people can't, right? So, which is why I didn't really understand the whole, let's switch to e-commerce. That's a scalable market. 3 years later, it's not as if e-commerce dwindled by any stretch of the imagination. But now let's switch to healthcare. So, like I said, nothing wrong with that. Some people may view it as opportunistic. You may want your CEO to have these kind of traits. However, inherently, I do think that once you are a company that pivots from uh, one sector of the market to another, that tends to mean that you are not the leader in the space, right? Because you're not the one that is building up the new infrastructure or the disruptive innovation from the ground up. Now, that is not always the case, but I'm just saying by and large, that tends to be the trend. Now, that also means I can't say, like I said, for sure in the next 10 years, this company will not rebrand themselves in another way that rechanges the scope of the business again. Now, I'm going to play you a small clip in this interview that I've listened to. Now, if there are more interviews out there that Justin is a little bit more cohesive, you can let me know. I'll be happy to listen to them and update my thesis again. But at around the 10-minute mark of this interview, that's what I'm going to be playing for you. We're just going to listen to a couple of minutes because over here, the interviewer, Alpha Wolf, basically asked him about what he felt about regarding the advantages that LifeMD has. So basically, to give you the context before you listen to the video, one of the advantages that LifeMD has, at least advertised to have, is that they have they have your primary care physician. Never really understood this term, but after reading into this company, I had to understand. Okay, so your primary care physician is basically that is someone that follows you through for the bulk of your treatment, and apparently, and not every hospital gives this, right? So if they are able to provide that for a patient, then I think the fact that LifeMD can assign a primary care physician to a patient is definitely a moat for the company, because I can see a group of people that really wants to have this primary care physician seeing them through their whole trajectory of their treatment. However, when you listen to his response in this interview regarding the primary care physician, it's a little bit confusing because he talks about family care. So I'm not too sure. Okay, the last one. Okay, that could possibly because I only heard two of his interviews, right. So I'll just play that small clip, and then perhaps Sagik, if you have some text to give around this, because I don't understand why he was talking about family care. So maybe he misheard the interviewer. I'm not too sure. All right. But I think that if this is really the case, and if Sagik you can confirm that this is the case, then I think this is definitely a moat for the company. That if other, because I know HIMS doesn't offer a primary care physician, if I'm not mistaken, at least not yet. Right. So if this is something that they can guarantee a patient, then it seems like this is going to be a moat for the company, because there are people who really just want to see a doctor and not a nurse practitioner and things like that. Where is this? I believe this is the one. So if you say this is his worst interview, then I mean, of course, everybody have their bad days. I can understand that, because this particular interview, I've heard two. This particular one really wasn't the best. Yeah, let me just play it for you.
All right, so let's. I want to point out a couple of highlights.
Okay, sorry, I was listening to it. Yeah, let me listen to it at normal speed.
Things. So one of the things that is really nice about your telemedicine or teledoc or whatever you want to call it, right? Is that you get, instead of like with some of these organizations, you don't have a primary care physician. You have whoever you get on the phone, right? With you guys, you can have a primary care physician, right?
Everybody, every provider that works for LifeMD or treats LifeMD patients is trained in family, is a family practitioner. We use more nurse practitioners than doctors right now because, again, the dollars just go a lot further. And what we found is that for most of the conditions that we treat, the MDs on our team can work closely with nurse practitioners. They're really, really smart. They have a lot of experience, and patients are just as happy with a nurse practitioner for most of these things as they are with a medical doctor.
That makes sense.
All right. So you heard what he said. He's basically telling us that, hey, you know what? We offer people the chance to work directly with their own primary care physician, which is someone that's going to see them through. Now, however, during this interview, like I said, perhaps he wasn't very clear. If this is actually true, like what Sergey said, then this is definitely a moat for the company because they are providing people a form of care that every there provides. However, in his interview, he also did mention that how it works, at least for them, is that it seems as if he's saying that, hey, we have this primary care physician, which is an MD on our team that's overlooking your case, but basically they work very closely with a team of nurse practitioners. And he says that patients are just as happy. So I'm not too sure, is he trying to say that, hey, even though they don't have a PCP, patients are just as happy? Because I'm not too clear what his answer was over here, like whether or not do they really have a PCP and how is it being practiced. But I think if you take a look at the customer satisfaction score, that doesn't lie. Later on, I'm going to show you. It's currently stands at around 4.91 out of 5. So I mean, the experience itself, customers like it, right? And I think personally, whether or not you have a primary care physician, whether or not you actually see an MD or a nurse practitioner, to me it's that big a deal. I think nurse practitioners can be just as good as MDs, especially the experienced one, because I do know of my friends who are nurses, physios with a lot more knowledge than some of those doctors out there, especially the junior doctors. But I think from a business perspective, if you have one MD overseeing the person's case and consider that a primary care physician and then let them interact majority of the time with a nurse practitioner, that is a good model from a healthcare perspective, from a patient's perspective. But from a business perspective, then this is no longer differentiated because that's what other companies are doing as well. So this interview here didn't make it very clear to me that they specifically have one MD or one PCP for, or must a PCP be an MD? That is something else that is also not very clear in this interview. So I would like to have more clarity about this to determine whether or not I feel like this is a moat. Like I said, if they do have an MD as your primary care physician throughout the entirety of your treatment, then I think it is a moat, and then I understand why perhaps later on you're going to see their scaling is not as quick as some other companies. But again, so like I said, with all of this in mind, let's take a look at their business proper and try and understand how they actually make money. So if I dive into the actual business, LifeMD is a direct to patient telehealth company, and they aim to provide basically a high quality, cost effective, and convenient way to access comprehensive virtual and in-home healthcare. This is taken straight out from their 10K. Simply put, they have a platform, and in that platform, they give people access to a vast network of doctors and offer real-time virtual consultations with licensed providers. Okay, sorry, I just want to stop myself. So their PCP can be either an MD or a nurse practitioner. Now, I'm not too sure about how it works in the US, but like for companies like HIMS, because I know some of these companies, HIMS, even like Oscar Health, when they work with certain healthcare providers, they have a lot of nurse practitioners on their on their team. So does that mean for companies like HIMS, for even the insurance companies like Oscar, they will, for your same condition, they will not necessarily assign you the same person, like the same primary care physician? Is this their moat? If so, then okay, then later on when we do the framework, I'll be giving them points for that. Yeah. All right. So let me carry on. You can answer that in the chat below. So basically, LifeMD is this platform. They offer you access to a vast network of doctors, nurse practitioners, and they offer real-time virtual consultations with licensed providers. And then what they do is that they don't fulfill the prescription themselves. They are not like HIMS. HIMS have their own pharmacies and things like that. But what they do have is that they have all these fulfillment partnerships with pharmacies around the countries, and they also offer lab testing as well as marketplace for over-the-counter healthcare products. So I believe the fact that LifeMD is using all these virtual consultations and having that provider-patient interaction, it does help to build higher trust, leads to higher customer or patient retention, which is why customer satisfaction score has been so high for them. And in their ecosystem, LifeMD, which is their main telehealth brand, offers access to virtual and primary care, and they basically serve over, I think, 200 different conditions, right? Now, RexMD is another part of their telehealth platform. It offers virtual medical treatment for a variety of men's health, including things like ED, as well as hair loss. And how this works, right, is that patients get a consult and a treatment with an affiliate licensed physician, and then one of the partner pharmacies will then dispense and ship the prescription medication. Now, the last part is Shapiro MD. Not too familiar with this. This is basically a legacy brand that offers hair treatment, right, for both male and female. Like I said, all of this is under their business overview found in their latest 10K. Now, so there are basically a couple of ways that LifeMD generates revenue. Currently, the primary revenue driver for them would be their healthcare subscription services. Now, this doesn't include some of the healthcare programs that they have with other partners. For example, the GLP-1 weight management or RexMD for men's health, right? So the revenue from partnerships are counted under product sales and marketplace. So this basically refers to direct-to-patient sales of branded engineering medications as well as testing services. So these are usually bundled together with all their different care plans. So apparently you subscribe for, at least from what I understand, you subscribe for a care plan, and then after that you can bundle these things together, right? Additional GLP-1 weight management treatments and things like that. So one of the things that they have really been pushing is that the fact that they are really, I think they are pushing their partnerships that they have with all these big companies. Lilly Direct, which belongs to Eli Lilly, as well as NovoCare, which belongs to Novo Nordisk, right? And they allow GLP-1 access. So they suggest that because they are the only provider, right? LifeMD is the only provider offering real-time patient care with cash pay access to both Wegovy and Zepbound. This is actually a moat for the company because they're the only company in the US that offers that. Now, I don't know how you guys define a moat. At least for me, a moat is something that the company can actively build out and strengthen. Now, in this situation, what you can say they're differentiated because they offer both Eli Lilly's products as well as Novo Nordisk. But to say that it is a moat means that there's something they can do to actively build this out. But if you recall just a while back, Eli Lilly said that they want to build out their Lilly Direct even more, and they have some affiliations with another healthcare provider that is not LifeMD. And on that day, the LifeMD stock actually fell. Because this is what some of these bigger companies can do. At the end of the day, if you are not able to do anything to continue to build out this moat, then it is not a moat. To me, this is a point of differentiation, and it is due to the regulation right now, due to the supply and demand dynamics right now, that they have this differentiation. But it's not something that I would consider a moat. And I think, to be intellectually honest with myself, whenever I spoke about HIMS, I've always made the distinction that this GLP-1 is somewhat of a macro tailwind right now in the healthcare space, but it is not a moat by any means of any stretch of the imagination for him. So I think it's not fair to say that suddenly when it comes to LifeMD, I would consider it a moat. But like I said, this is something that differentiates them. However, if you are buying this for GLP-1 exposure, if you're buying it purely for GLP-1 exposure, then I think I see some reason in people buying some of the bigger companies like Novo Nordisk and Eli Lilly. I'm personally not too interested in playing such a specific tailwind within an entire macro. But I know of some people who are buying Novo Nordisk and Eli Lilly. So do with that what you will. But like I said, LFMD, proxy for GLP-1 HIMS. And in LFMD's case, I can understand why people would say that it is a proxy for the GLP-1 story. Whereas with HIMS, it's even less so of a GLP-1 story because of what just happened, dissolving the Novo Nordisk partnership, right? Yeah, so in this interview that I was showing you earlier, if you guys are interested in some of the interviews, I'll link it down below later on. Part of this interview, around 13 minutes in, Justin was asked about, disruption in the healthcare space. Now, I was excited to listen to this part of the discussion because I wanted to know what is LifeMD's what makes them special in this space rather than just being a platform. With HIMS, I can tell you, yes, they have a platform that's very intuitive, that customer side, that you get live consults with doctors. But HIMS is differentiated in the sense that they own their own pharmacies. They help people compound drugs. They have their personalization. These are things that protect them against disruption. What Justin was saying in that interview is saying that AI and technology will disrupt the healthcare sector. People are going to be able to people are going to be able to deal with a lot of their health conditions at home. And so because of that, they will need a way to gain access to the US healthcare systems within the comfort of their own home or on their mobile devices. And because of that, LifeMD provides that access into that wide network. Whereas, so to me, that seems like AI technology is disrupting the healthcare. And because healthcare is becoming more accessible, you're just giving people an easy way to access the healthcare. But what are you, your company, LifeMD, doing to build a moat for yourself? Because someone else can come in. I think we were just discussing this the other day about companies like Duolingo, where if it's a platform business, could be easily disrupted, but you need to offer something else to people more than the platform. So I'm looking for that something else more than the platform from LifeMD. As a platform, fantastic. The PCP is one differentiation. GLP-1, another one differentiation. And yeah, I think right now they are definitely in the correct macro if they're trying to catch a secular tailwind where healthcare is getting more and more. If we're able to diagnose a lot of these smaller conditions at home, people need to be able to access the US healthcare system from their homes. And right now, LifeMD really provides one of the best experiences, right, according to customers out there. However, like I said, I need to know as well, how are they protecting themselves from being disrupted? If anybody has any idea of what they're trying to do to protect themselves from being disrupted, do let me know. Now, finally, the last part of their business is this product here called Work Simpli. This one kind of annoys me a little bit. In the interview, he actually said that he can divest from this business, I think $80 million, something like that. But the CEO seems to like it because it is a cash generating business. What made me be okay with this was later during the interview, he also admitted that he understands, shareholders like me, if I want to be a shareholder, they're going to get annoyed because you're having all this money locked up in this business that is nothing to do with your core business. You can take this $80 million and build out other verticals even quicker within your core business. His rationale for this is, I know the person that owns this, basically, he's a good person to invest in, but still, like I said, maybe because he comes from this venture capitalist background, he tends to have a little bit of that. And I think I view this in a very different way from what Google does or what Palantir does with their smaller bets, because Palantir is giving their ontology to these smaller companies and let them use it, right? Whereas this, they really, I mean, yeah, okay, like it's very, in all likelihood, LifeMD users work simply within their entire office and things like that. But yeah, it's not really their core business. So I don't know what to make sense of this. I just feel like, okay, they should take that $80 million and build out the other aspects of their business even faster, right now, because I mean, I think they can do with an injection of cash to spur their growth a little bit. HIMS needs to fight the entire system, and it's a hard system to fight. LFMD isn't fighting the system; it is a distribution channel for the system. Okay, so that is definitely something to consider, which is why, you know, companies like Eli Lilly, Novo Nordisk are okay to work with LifeMD, right? But you can see they are not interested in partnering with someone like HIMS. And I think at the end of the day, I think we think of the future outcomes as some sort of binary. Either we completely demolish the legacy system or we don't. And I think it is not do we or don't we, but to what extent do we change the healthcare system. So that is why I do think that these two businesses, LifeMD as well as HIMS, both can exist at the same time. For me, I prefer, I'm a bit comfortable with him because they seem like a leader in the space, right? Whereas LifeMD, like I said, if they are a distribution channel, I'm trying to find out what are they doing to protect this distribution channel. Because I like I said, with that said, I'm also well aware that it's not that easy to disrupt a distribution channel, because you could just as easily say that, you know, FedEx is a distribution channel. They've been surviving all along. But I mean, like right now, Amazon has started to build out their own logistics network. And because of that, you're starting to see disruptions in FedEx and UPS and things like that. So my point is, I'm just wondering, what is it that LifeMD is doing to protect themselves, and so that they can become the distribution channel that people go to for healthcare, right? Right. So to me, I find this particular product works simply. I understand that it generates cash for the business, but if you take a look at the results later on, you realize it's not growing that fast anymore. And I think it's high time that, you know, they actually take the money out from this investment, which has done well for them, and then, you know, reinvest it back into their core business. Right. And I think it skews the number a little bit, because they like to report the total subscribers, and then they include the subscribers from Work Simply into their subscriber number. So it actually dilutes their number a bit, because their healthcare platform is growing at a decent level. And then some Work Simply, sometimes the number tend to pull their healthcare numbers down. So it really does them a bit of an injustice when you count it together. But like I said, when you listen to it, it seems to be him supporting his friend. So I think to a certain extent, up to a certain point, I think he has have to divest from this business, and he's aware of that. So I'm fine as long as he's aware of that. He's not like planning to keep this business on forever. So I'm perfectly fine with that. So at this point, I think it's important to also discuss some of the narratives around the company and what has been going on. So I think the two things to understand about LifeMD, where they are slightly different from HIMS, I think we have spoken a little bit about that, is the insurance aspect, where they accept insurance, but they also offer branded GLP-1s on the platform. And I think with LifeMD, because they are still such a small company, there are a lot of aspects of their business where it's either you believe them or you don't believe them. There's really no middle ground over here. You see, one of the reasons why the stock fell 45% is because of refunds. And this is why I always say, you know, potential is a dangerous word. Because when management first got into insurance, they told you all the positive aspects. It's going to expand the number of people that can use their platforms and things like that. But when you look at the data, it seems like the risk of going into insurance has been a little bit underplayed. And in this particular instance, I think what correct me if I'm wrong, but what seems to have happened is that patients may have made certain orders through LifeMD, and then when their claims got denied by the insurance company, patients who have made these orders will then have to refund their prescriptions. So to me, This adds an additional layer of uncertainty to their overall revenue, and it is a risk factor that other companies like HIMS doesn't have. However, it does open up a bigger market for them because it is not just cash pay, they do allow insurance. So I think do with that what you will. You either sit on either side of the fence. You think it opens up a bigger market and that risk factor is worthwhile taking, or you think that with this risk factor, it's very hard to say. It's basically down to the competency of management to gauge how much refunds they have to make in that quarter, and then because of that, they tend to they tend to have a little harder time making guidance for the company. Because if you look at how insurance companies tend to pay out, their medical loss ratio, yes, they'll give you a defined, we are doing 80 to 85% throughout the year. But if you take a look at the medical loss ratio for insurance companies like Oscar Health, UNH, the claims tend to be a lot slower at the start of the year because they're keeping cash on hand in case there's something that happened later on in the year. But towards the end of the year, especially Q3, Q4, you start to see the medical loss ratio going up 90% despite their average being 80 to 85%. Now, the reason is earlier in the year, they are a little bit more strict around how they pay out their claims. Towards the end of the year, because they have to hit certain medical loss ratios, they become a lot more lax in terms of how they pay out claims. And if that can cause cyclicality in the insurance space, and you're in the insurance space, it's something that you have to understand that this will be an aspect of LifeMD's business that is not there for other companies, and different people may look at that differently. Okay, so that is one layer of uncertainty. I think the other aspect over here is that they do have to have this additional layer of or they do need to work with the insurance companies to open this market up for themselves, because unlike HIMS, they don't have their own pharmacies and things like that, and there's no differentiation factor for them. And so because they can't do things like personalized treatments and things like that, because I think, if I'm not wrong, when they signed the deal with Eli Lilly as well as Novo Nordisk, they are not allowed to sell compounded drugs on their platform, so they had to find other ways to basically increase their TAM. Now, the second issue that you see over here is that LifeMD faced increased competition in the men's health market. This led to an increased customer acquisition cost. Now, at some point of this quarter, they say that the customer acquisition cost was up. It's not here. Was up around 15 to 25%. And they tell us that because this customer acquisition cost was going up, we're going to have to pull back on the amount of volume that we drive through the business. And then their solution here is to diversify the business so that in future, when they have this kind of price disruptions, they can repurpose their capital to drive growth into other. Oh, they did compounding. Okay, that's interesting. When the shortage was still on, they stopped in May when shortage ended. Okay, they can repurpose their capital to drive growth in other aspects of their business. How did they do compounding? Because I thought that they didn't own their own pharmacies. Because they do partner with pharmacies, so they offer compounded drugs through their partner pharmacies. Am I right? Is that now with the regulation back in place, they are not able to do that? And I think both of these companies, I think you got to accept, right? They both hold their own inherent risk. Like with HIMS, they're using the personalization aspect of the pharmacy. I think 503A, 503B, and to say that these facilities fall within the categories where you can actually compound medication for personalization. Oh, they do? Okay. Let's see. Because when I was looking at it, LifeMD launches affiliated pharmacy to drive end-to-end patient care instead of the pharmacy with. Okay. Okay, LifeMD. All right. So they open their own pharmacies, right? They have one in yes. Okay. Uh okay, they opened that in November 2024. Am I right? I think that's the one that you're talking about. Let me see. Let me see whether I can find this for you. Basically, for those of you who are, yeah, I'm trying to determine to what extent do they own their own, does LifeMD own their own, the different aspects of the healthcare system? Seems like they do own a pharmacy. They opened it in November 2024, but they don't compound drugs. They are able to provide compounded drugs when there are shortages, but they are not able to compound drugs on their own. Yeah, maybe I'll look into that later on when we are doing the regulatory part of the video. Okay, let me carry on first. Later I'll look into the regulatory part of the video at this when we are covering the framework and things like that. So the reason why I am concerned about this, or this is one of the things that uh, I actually thought about, is that because um, the issue that they face, like they said, is okay. So first things first, you have to understand that they said that, hey, we saw this increase in customer acquisition cost by anywhere between 15 to 25% in the men's health segment. So because of that, we had to pull back on a little bit of marketing, and that's why the throughput for our business is lesser. Now, to diversify the risk, they plan to go into different verticals. Now, my question is, why didn't you sell Work Simply earlier to do that? You know, this seems to be a little bit more reactive than a management team that has a little bit more foresight into the space. And that is what I mean by they seem to have, see, this is where when I read things like this, I can't tell whether or not he's supporting his friends, so he's keeping Work Simply on, as or whether he likes the cash generation, or is this really a misstep by management where, you know, GLP-1s boosted their growth by such a large amount. They never really, because of that, they didn't take the chance to really, they tried to really focus on growing the GLP-1 segment of the business, and they missed out on the opportunity to, you know, during that period of strength, to actually branch out into several different aspects of their business. Because to me, last year, when the GLP-1s was actually booming and they actually had such a big growth spike in their numbers, they could have taken the chance, sell off Work Simply, and then use that capital to actually build out into other aspects of the business. But it seems like they did not do that. And then because of that, so right now, when they are suffering in the men's health department, then they're starting to see this. So later on, I want to show you the numbers and what exactly about the numbers that are a little bit concerning to me. But when I read about the slowdown in the men's health segment of the market, initially, like I said, I didn't think it was a big deal, because I do remember HIMS reporting a slowdown in their men's health department as well, right, as in the sexual health components. So I went to dig into the transcript of HIMS, and I have seen people say that, you know, the two situations are the same, because HIMS have said that they're slowing down. LifeMD is also said they're slowing down, so both of them are the same. Okay. But I'll be very honest, there's no other way to put it. I'm not too sure what transcript they're reading. The two situations are not the same. Both of them are slowing down, yes, but it seems like it's for vastly different reasons. I'm going to read you what it says in the HIMS transcript. What we are seeing is that there's a drag coming from the sexual health on-demand component of the business. On-demand means, you know, when I need it, I'll go and buy it, and then they buy it through HIMS. what we have done over the last couple of quarters is that we have expanded the sexual health daily offering that continues to grow north of 55%. And we do see very strong retention across the daily relative to the on-demand business. So they're shifting their product mix, they're shifting their client mix from their sexual health on-demand to the daily subscription. Now, what that actually means is that generally upfront, when you're paying for something over the counter, that cost you tend to pay a little bit more compared to a subscription, right? That's how they get you onto a subscription. It's probably slightly more, it makes a little bit more sense for you if you're using the product on a regular basis, rather than to have to keep forking out money over the counter. So because of that, there's going to be a slowdown in their revenue as they transition their customers over. But why they're doing that is that because in the long term, they're seeing better retention dynamics. Now, they also tell us that, hey, you know what? This is just going to be happening for the next couple of quarters. And overall, in the second picture, the overall base of our sexual health customers is a lot healthier. And as we start to lap these dynamics in 2026, which means that this year, they said that, you know what, Novo Nordisk partnership has already, gone to shit. And then after that, now we are also transitioning away from more on-demand products to more daily usage products. So we are seeing a slight slowdown in this particular area, but however, that's fine because in 2026, once we have shifted our customer to a more healthy product mix, then we are expected to actually receive a benefit from both lapping and then also the stronger retention on daily health users. So the reason why HIMS saw a slowdown in the men's health segment is not to do with an increase in customer acquisition cost. It's not to do with volatility in the customer acquisition cost. It has to do with shifting the product mix to a daily offering product that basically drives longer retention for the company. And on the surface, these two look the same, but if you read the transcript, the reason for the slowdown for LifeMD, it is because of an increase in customer acquisition cost that they cannot keep up with. But for HIMS, it's an intentional shift in the mix, and they tell you very specifically, 2026, when we're lapping this, we're going to do much better because we have a stronger customer mix, we have a stronger product mix, and we are going to see stronger retention as well. So I think this is two vastly different reasons. And so whoever that you hear or read or say that telling you these two things are comparable, it is not. Point them to the transcript. These people probably never read the transcript. Okay? And then HIMS did mention marketing volatility over here. Also in the same transcript, by the way, they said that we saw marketing volatility, but what is the reason for the marketing volatility? That is due to the onboarding and offboarding of a previous collaboration within the second quarter, obviously referring to, the Novo Nordisk partnership dissolving. And they say that, you see, the problem now is that they have strong performance of their non-weight loss offering as a result from improving retention, talking about the sexual health side. That basically offsets some of these volatility. And so because of this, it's a bit hard for them to gauge how well or how efficient their marketing spend have been. And because of that, it's a little bit hard for them to measure their marketing this quarter. But if you look at it on a gross margin basis, their gross margin expanded, right, 3 points quarter over quarter. So basically, they're telling you, yeah, there's a little of marketing volatility, but that has been made up by our higher retention in other products. But it's a little bit hard to tell how efficient we were because, there are customers onboarding and offboarding our platform because of the GLP-1s. So, like I said, two very, very different reasons of the reason for marketing volatility and two very different reasons why they saw challenges in the men's health space. So, to me, this means that the increase in customer acquisition cost experienced by LifeMD is, something that is not a macro problem. It's actually one that is specific to their business. So unless the only option here is that HIMS is lying, and we'll see it in, HIMS Q3 report. But apart from that, it really doesn't seem to be the case right now because HIMS sound pretty confident. If they keep up this tone and they go into the second half of 2025 and they do not deliver, the market will punish the stock, right? And I'm not suggesting that. Now, I'm not suggesting that there is a direct correlation, but naturally, this is where my head shifts to. Like I said, no proof of this happening. I'm just putting the two transcripts side by side. Okay, imagine you are a person that uses an on-demand sexual products, and sometimes you get it from LifeMD, sometimes you get it from HIMS, because I think prices are more or less the same. I guess depending on who gives you a better price at that point in time when you need it, you will just get it from that company. However, because now HIMS offers you this, hey, you know what? Get the daily version, lower dosage. I can't remember what's the name of the lower dosage, but you use it on a daily. Then you don't have to worry about it. You don't have to get it on demand. Just use it daily. We give it to you on a subscription. It's a lot more savvy for you like this. So people say, oh, okay, you know what? Subscription sounds good. Instead of going from on demand, now they go, hey, you know what? Let me subscribe to HIMS. HIMS sends the products daily. They adjust the dosage for the customer so that it's lower dosage. That's why they can take it daily instead of on demand. And with this group of customers that are purchasing men's health products, now shifting over to HIMS subscription products, that means the market has shrunk. And because of that, there naturally is an increase in customer acquisition cost, because it becomes a lot more competitive on the on-demand side, because a lot of the on-demand customers are shifting over to the subscription customers. And so once they're on the subscription plan, they're much less likely to go back to the on-demand solution, and that causes difficulty. HIMS already tell you, we are seeing that, right? Our on-demand is slowing down, but that's because we're shifting them onto our subscription products. But I'm too sure about whether that's the case for LifeMD, whether that's why they're seeing higher customer acquisition costs. That could be one of the reasons. Some analyst reports that I've read suggested that this is just another way of saying management missteps and execution, a lack of execution in this particular area, which is quite likely as well. Because when I was looking at the management team, HIMS management team have 2 MDs on their C-suite. That I believe with LifeMD, they only recently just got MD on their C-suite. Previously, they didn't have any. Of course, their board of directors is pretty decent for both companies, well staffed. But my point is that the C-suite themselves, HIMS seem to have a little bit more balance than that. So that might be why there are certain operational missteps, and that is something to be expected of a young company. That doesn't totally discount them, but you have to understand why some of these missteps are happening and whether or not you feel comfortable with that as an investor. So I think, to me, you have to think about it in the sense that, we have seen the LifeMD's business re-rate because of the GLP-1 boom, right? Like I said, broadly speaking, as an investor in the healthcare sector, there's a lot of excitement around GLP-1s, but I don't foresee this to be a moat to build your company around, because I think especially if you're relying on some of these bigger suppliers, it represents concentration risk. And should there be any shift on policy, or if the big boys decide to scale their own telehealth services, then they could easily undercut you. So, which is why, like I said, I always felt like it is important for these smaller companies to be aggressively investing back into business, to grow their business at a pace that is, much faster than the big boys. And so at this point in my research, I already had some concerns, right? I was concerned over the management pivoting a couple of times. And then after that, looking at the struggle that they have with customer acquisition and not having a very clear reason why, I wanted to really see, how different is their level of execution. So I did a little bit of digging. Now you can tell me at the end of this whether or not. Hi Jay, hello Jay, good morning. Hello Jay, is that right? Good morning. Happy Labor Day to you guys in the US. And like I said, for my listeners in Singapore, too bad, back to work tomorrow, right? And there's no holiday today as well. Yeah, it's Labor Day for you guys in the US, but unfortunately for the other part of my listeners from Singapore, everybody went to work today. Everybody's going back to work tomorrow. And I think everybody's kind of sad that the market is not open. I feel like a degen, right? I feel like, when the market is not open, there's nothing to do. Like I look at my phone at 8 o'clock in the morning, and I realized, oh my goodness, it's still, it doesn't show me my 24-hour market. So something feels missing in the morning when I wake up. Yeah. I totally forgot it was the Labor Day today for you guys. And then until I woke up this morning, checked my phone at like 8 a.m. and overnight market's not open. And then I realized, oh yeah, it's Labor Day. So anyway, the withdrawal have to last for another, less than 24 hours at this point. No, okay, I'll be excited to wake up at 8 a.m. tomorrow and see how the markets react. Yeah. So like I was saying, I was already having. I'm pretty on the fence with LifeMD. I can see the bull case. I can also see the bearish case, and I'm not really decided. So I let the numbers do the speaking for me. Now I did a little bit of digging. Now LifeMD only launched their platform back in February of 2022. So yeah, it's been around 3 years since they launched their platform. And I wanted to see what does that look like for them. So in Q1 of 2022, you can see over here that the total active subscribers under the telehealth segment is around 164,605 members, right? So when you're looking at their subscriber numbers, you have to bear in mind that they combine subscribers from both the telehealth and the work Simpli segment. So you have to separate them when you do your analysis. You can just look at the total subscriber count numbers. I think it's quite weird that they would do that. Like, why would you consider that total subscriber count? I don't know. That's why I said, this work Simpli is like it's like a pebble in your shoe. You just want to get rid of it. Anyway, Q4 2022, this number increased to 168,197 members. At the end of 2023, this grew to 215,203 members. Now, so between Q4 2022 to Q4 2023, this represented 27% year-over-year growth. And in December 2024, this number increased to 275,000 members, which is another 27% year-over-year growth. So like I said, not as fast as HIMS, because HIMS, even though this is supposed to be a slow quarter for them and they're still growing member count, I think over 30%. So I think what is concerning for investors is that if you look at the numbers reported in the most recent quarter, in Q2 2025, they reported 297,000 members on active patients on their platform. 1 year ago, Q2 2024, this number was 253,000. Now, in the past, they've been reporting 27% year-over-year growth. This quarter, they only reported 17% year-over-year growth. Reason they have given, like I said, is due to the customer acquisition cost. Now, in the management comments, they said that it has been largely dealt with, and these are temporary challenges. So largely dealt with, not fully dealt with, means we are going to continue to see some headwinds in Q3. And then perhaps, and I'm not too sure in Q4 what are the numbers going to be like, but that means they don't just have to do 27% this year, they're going to have to do more than that. And then when you look at the revenue growth, since they got their platform, they grew revenue by 28% in 2022, 28% again in 2023. And last year, due to the boost of GLP-1, they grew revenues by 39%. Now, right now, because of the high competition in ED, which is in their most earnings call, they did tell us that they, like I said, they have dealt with majority of wins, largely, and they are, despite having largely dealt with most of the headwinds and having temporary challenges, they're still guiding for a 20% year-over-year growth. And that's why I think the numbers tell me a different story from what management is saying. Now, management have used words like temporary challenges, largely resolve the problems. And I think the sentiment that investors have is that these are pretty weak arguments or pretty weak statements from management. Because in 2023, you had GLP-1s. You are the only company in the US that can sell branded GLP-1s. So that boosted your growth in 2023. Now, unlike HIMS, they still have these partnerships in place in 2025. However, just because of the high competition in ED, it basically wiped out a large portion of their growth. Half. It wiped out half of their growth. So to me, I think that's why to me, I always felt like the every time I did my video, I always start off with the sentence, potential is a dangerous word, because it's true. Management can tell you whatever the heck they want, but the numbers don't lie. Could they be conservative? Yes, definitely. So we really have to see whether or not how much they actually beat this 20% number. Right? Because right now, the numbers and what management is saying is a little bit incongruent. So let me just play you a part in the video. Sergey has already told us that this is one of his worst videos. So, I've only listened to two, but the other one was talking about Q1 results. And Q1 results were were actually good. But he didn't say much about, some of the recent concerns that people have around the company. Let me just play you a short clip from that video. I believe this is around 6. I put 16 minutes.
Thought they were going to have 37,000 patients. They only have 33. So I don't think all we need is technology. I mean, we need the right technology. It's going to.
Okay, so over here, he ends off his conversation talking about technology disrupting the healthcare sector, and then because technology is disrupting the healthcare sector, people don't need to go into the hospital so often, and because of that, LifeMD is well positioned to take advantage of this secular trend. Now, then he uses that to, in a sense, justify the slowdown in growth. I'll let you listen to what he said, and then I would give you my perspective, and you tell me where it makes sense.
Take 5 or 10 years to, for it to mature, and it's hard to get physicians and healthcare organizations to embrace technology. You have to make sure financial incentives are aligned as well. But over time, this is going to happen. And this is why I'm so enthusiastic about LifeMD. And this is what people miss when they start saying, oh, well, the telehealth business only grew 20% this quarter, and there was $500,000 off on the bottom line this quarter, and they thought they were going to have 37,000 patients. They only have 33. It's all, look, we have a business that's well capitalized. It's never going to run out of money. And we're in still, in my opinion, the most exciting and biggest growth market in my lifetime. That's why I decided to run LifeMD, because even before GLP-1s, I knew that I would never be able to run a company that was an early mover in what I think is going to be a multi-$100 billion market shift. And other smart people think that as well, over the next 10 years, not the next 50 years. But this is an imminent, massive market shift. And then we woke up one day, Tim, and we saw GLP-1 medications. And then they added another $100 to $200 billion a year to the TAM potentially. And LifeMD was perfectly positioned for the GLP-1 market because of this incredible virtual and in-home care platform that we had spent the last 2 years building.
All right. So for me, my investing style is one where I like it where the management tells me something, and then there's something that the management can actually point to tell me, hey, look at this. If you look at this, you will know that our business is doing well. Right? And I think there was a missed opportunity over there, because when talking about the slowdown, he didn't directly address the slowdown. His answer to why his company is slowing down is, don't worry, we are in a fast-growing market, and don't worry, we will not run out of money. And later on, if you have been investing over the last couple of years, right, you have heard, I'll give you a very quick example, just off the top of my head. I think a couple of you actually saw my cost basis for Palantir is negative $200. Because I realized my profits from Palantir, moved it into other companies. And the reason why my cost basis on Palantir is negative $200 is back when Palantir was growing at 13, 14, 17% year over year. Everybody was telling me the growth is dead. But you just had to look at one number. That is the number of people, number of customers that they signed during AIPCon. And as long as the number of customers were increasing, people are saying, you got the customers, where's the revenue? They didn't understand that Palantir's business model: land, expand, scale. And it's either you believe it or you don't. And it's the same thing with LifeMD. There will come a point in time where they will have to put up the numbers. Right? If Palantir was telling us, hey, look, just track the customer count. As long as customer count is growing, our business is growing, and eventually these customers will pay us. And once you reach and from the point where they told us that you can count 3 to 5 years later, what's going to happen? And you are seeing that exactly now. Customers are paying, which is why they're delivering the revenue growth. And you just heard what the CEO said over here. He didn't give us anything to know that the business is doing well, other than the fact that you're in a fast-growing market. Apple is in the AI market, but I don't think any one of us thinks that Apple is, at the cutting edge of AI. And I think right now, I just feel personally, he hasn't really given me confidence to say that, hey, this is a guy I want to give my capital to, because his reason for investing into his company is we are in a fast-growing market, so are HIMS, and we have a lot of cash. We're not going to go bankrupt. So are HIMS. Nothing to do with, something that they have that is differentiated. And then I want to look at the numbers even more. It's not just their revenue numbers that got cut, their adjusted EBITDA numbers got cut. Now, previously, they were guiding for 20 million at the end of 2024. In Q1, they increased this guidance to 21 million. Right now, they're guiding for 14 to 16 million. Now, this tells me that they're overly concentrated as well. Because just by losing some of the business in the sexual health department, they cut so much of their profitability, which means a large part of their business is dependent on that men's health segment. Which all the more I question, why didn't the leadership have the foresight to diversify the business? And again, I fall back to because they're opportunistic and they're not the market leader. So the way that they approach the market is very different from a team like HIMS, from a team like HIMS basically. That's who they have really been compared against. So you can see if you compare it from the 21 million, that's nearly a 30% decline in their guidance. And then if you consider 20 million was their Q4 guidance, that's a 25% decline in their guidance. So you have to bear in mind, this is even with the GLP-1 still boosting their revenue, which means the decline is actually more than 25-30%. Because without the GLP-1s, this is going to look much uglier. And like I said, why I'm still curious why they haven't chosen to diversify the business. Like I said, don't want to jump to conclusions, but I'm only human, and my mind naturally makes that connection of, you know what, 3 years ago you're an e-commerce business. I don't expect you to know how to keep up with the healthcare trends that well. That is my personal bias over here that I have to be very aware of, that could blind me from seeing a potential opportunity. But like I said, skeptical management. I mean, according to what Sir Geek said, there are better interviews, and I will possibly have to go and look at his previous interviews. But the last two didn't really inspire much confidence. Now, for those of you that would really think about this as an investment, I just want to give you some context. HIMS, over the last 3 years, grew their subscriber count by around 89%. Okay, but this is not accurate, because at this point, the scale that HIMS are at, it's actually quite unfair to compare them. So I went back to 2019. Why 2019? Because when HIMS was in 2019, they had 157,000 members on their platform. Okay, and I'm going to project out 3 years, so 19, 20, 21. At the end of Q4 2021, you can see HIMS had 609,000 on their platform. They quadrupled member count in the span of 3 years. Why am I using this number? Because, may I remind you, that for LifeMD, despite all the marketing and everything that the management say that they are so good at, in Q2 2022, they had 164,000 members on the platform. Today, they have 293,000. That is a 77% increase in members over 3 years. From the same scale, when HIMS were at 157, they managed to grow to 609 in 4x their subscriber counts in 3 years. And for LifeMD, they basically grew by 77% in 3 years at the same scale when they were the same size. Okay, so one company tells you they have the best marketing team or one of the best marketing team, but I think the results told me something completely different. You may say that it is not fair to gauge the performance of these two companies. I don't know. To me, I just feel like both are having good, both of them are having good reviews on their platform. But I think what makes this subscriber here grow so much more fast is because of all the other aspects of the vertical integration on their platform that HIMS can offer that LifeMD doesn't. Yeah, so to me, when I look at this, I feel that it is quite hard for me to want to give him my money, LifeMD's management, honestly. Yeah. I mean, if you want to put it another way, in when they are at the same business, when their business was in the same business cycle or in the same stage of business, HIMS grew 6 times faster than LifeMD has grown in a 3-year span. Which is why when you invest in the company, you can't just go by what the management tells you. The management will always try and paint a nice story. You have to be able to track the fundamental changes within the company and then use that number to back up the claim of the management. If whatever the management tells you, don't believe it until you can find a number to track it. And in this interview, to me, that is how because I don't run a very big portfolio. My portfolio is no more than 5 positions with 2 to 3 extra positions that are usually swing trades. So I don't keep track on more than 7 to 8 companies at any time. And the reason I do that is because I am so anal about the companies that I choose that if something the management say and I cannot, I will just not take that investment. And to me, that has served me well over the years. Yeah. It could also mean that I miss out on certain opportunities. That is for sure. And I think every strategy has its pros and cons, and you just have to find something that, you just have to find something that really works for you. We had a pandemic, telehealth going through the roof. That is not the same as that is a fair point. That is a fair point. Maybe I'll look at HIMS from 2022 to 2024, and then we can take a look over there. Yeah. But yeah, even this quarter, HIMS was growing at 31%, even with a slowdown in their marketing efficiency so HIMS had 2 headwinds and they still grew at 31%. And with a bigger base as well. So it's supposed to be harder for them to grow. Yeah. But I think what there, fair point. If you look at just before the pandemic, yeah, perhaps they would have doubled by then instead of quadrupled. But the thing is, these members all stayed on, you see, most of them. That's why they grew to where they are today as well. So I think that's important to remember. So, like I said, I like the company. There are a lot of aspects to like about LifeMD. There are also things that I am uncertain about. I've only spent about 1 week plus looking at this company. There are certain things definitely that are concerning to me, but there are certain things that I really like about the company. I like the aspect that they are going after insurance. I like the aspect that they offer people a primary care physician. I don't exactly think that they are the same as HIMS. I think that they are a platform company. And my concern with platform companies is that they can be replaced fairly easily. AI can come in and create a better platform, but they're not going to be able to personalize your medication to the way HIMS can. Yeah. And let's put it this way. With the skepticism that currently exists in our society of self-driving cars, in the US, perhaps it's getting lesser, but I can tell you in Singapore, that's not true. I think my parents, you ask them, none of them would sit in a self-driving car. To think that I trust an AI to get my medical prescription right, that is another stretch because that is life, even more life and death. So, but the AI can create a platform that is very good, that is very intuitive, that has good UI, UX, and things like that. That's why I said that the fact that HIMS have their own, manufacturing facilities, they are able to compound and personalize their own medications is an additional moat that they have that protects their business. And I'm trying to identify that for LifeMD, which at the moment I can't identify that. Like I said, the primary care physician is one moat, but I think that's about it. So I want to look at the valuation of LifeMD today. Like I said, I believe it is a good stock, not as good a business. I wouldn't say it's a bad business by any stretch of imagination. That's not what I'm saying. Decent business, better stock. And I'm going to show you why. Let's take a look at the valuation for a bit. Where is my valuation? Wow. Yeah. Okay. Let me share this with you. Let me zoom this in. I think by now, this should be fairly straightforward. You guys should know how this goes. Okay, revenue over here, basically in the most recent quarter, came in at around 22% growth. And then basically for the entire year, they are projecting around 20% year-over-year growth. Okay, so let me just do something right in front of you so that we can all take a look at it. If I'm projecting 2% growth, that means 0.2 the sum of entirety of last year. Oops. Again. We're expecting around $250 million. Okay, $250 million. Now, this, all right, I need to minus a 2 over here. And that means on average, I'm expecting around 63 million. Now, what is 63 million? 19% growth and 63 million again. Okay, I don't think they will put it, I don't think they will dare to put 63 million up as revenue in Q4 because that's going to be negative growth. That's going to look really bad. So chances are this is perhaps going to be like 60 and 66. Maybe. I don't know. I don't know how are they going to get to 20% growth. But after growing so fast, it means that there's going to be a significant slowdown for this year. And like I said, my concern is management hasn't really told us anything beyond, don't worry, we have a lot of cash and we are in a fast growing market. Right. So I really want to see what happens to that. I think this will be a company that I'm paying close attention to in the next earnings. Currently, 22% year-over-year growth. Okay, net income just turned back negative again. Shares outstanding. Okay, so when it comes to the shares outstanding, it's 44.5 million right now. Now, I think it's quite interesting to hear the management talk about it, and I'll account for this in my framework later on. But during that video that I was sharing with you, one of the things that inspired a lot of confidence in me, if I were an investor in this company, is that 25% of the company is actually owned by insiders. right? 25% of the companies is actually owned by insiders, which means that, the conviction of the insiders are very strong. Now, that's the first thing. Now, the second thing you have to realize is that the management has the C-suite basically has a lot of their bonus and benefits tied to revenue and EBITDA numbers. So it's not just either revenue or EBITDA, it's both. And I think this shows that, they're that's why I say, despite all my worries about, oh, they have pivoted before, are they not going to pivot again? I mean, the management has the incentive not to pivot anymore because of how much shares each of them own. That's the first thing. And the second thing being, they actually, Raymond, new mic. Sorry, I just saw your message. Not a new mic. Technically, my one is over here. I've been using this mic now in my old place. It's just that when I moved over here, somehow or other I couldn't get it set up, and I didn't know that you have to plug your mic into your computer. You can't plug it into the power source. That was why I had a problem working it for a couple of weeks. Fork is still here. My wireless mic is still over here, but yeah, I'm not using it for now. I'll probably use it when I'm recording videos. Yeah. So, like I said, for LifeMD, I think for me, what made me feel a little bit more comfortable with this is that to know that the C-suite has their awards being tied to basically business performance. So that means they hope that revenue gets to 150 to 250 million dollars. Now I believe he means every single quarter because 150 million, basically they already hit it if you're talking about on the annual basis. So right now, I think it shows that management at least are still in this for a relatively long period of time. That was why I was saying that initially my concern about them perhaps pivoting once the healthcare sector gets a little bit too saturated has diminished a little after listening to that conversation that he had. Okay, so this is basically the valuation that you see, number of shares. Now cash flow, the good thing over here is that they are cash flow positive, which is why management has said we are not going to go out of business every time soon. Now, you're never ever going to see me, say it's bad for the business to pay down debt, because they also redeem some of their senior convertible notes, along with the fact that, they are generating free cash flow. Now, is their margin slightly higher than usual? Yes. Could it be because of, trying to cushion the blow of the slowdown in revenue? Yes, of course it is. Definitely why their cash flow margin is so high this quarter. But I said, not a bad thing. Okay. If you can't put up growth, at least you are profitable on a cash flow basis. No one is gonna. At least people are. There is a. Yeah, basically there's a flaw now that people know that, hey, you have 36 million cash on hand and your cash flow positive. So if I show you the graphs over here, you can see the revenue growth basically plunged, and then you can see the revenue number decline as well. People are worried this is going to go down. I don't think so. Hopefully, I'm not exactly 100% sure. Yeah, I can't say. I don't know the business enough to say whether it will or won't. Or, to be very honest, sorry, I just realized you just got to ignore some of these numbers over here, because these are my Q3 expected. This was when I was playing around with some of the Q3 numbers. Give me a second. Oh. Oh, it's the labeling that is wrong. Okay. It's my labeling that is wrong. Yeah. All right. So operating income also turns slightly later. I'll double check on fiscal AI. Net income also just slightly turned negative. Let me just double check on fiscal AI to make sure my numbers are right. It's just the listing that is wrong. I sold at 14. I feel lucky. I mean, of course, it's $6 now. Holdings, Iran. Oh, Iran is good. Pretty interesting. I don't hold it. Wasn't into Bitcoin miners. I mean, I hold Bitcoin, Ethereum, Solana. That's about it. I don't hold the miners. SoFi, VG. Oh, I presume you listen to Chris Patel. The thing is, I'm an engineer by training. like I did chemical engineering at Newcastle University, UK, but yeah, I was horrible at engineering, which is why I turned out a teacher in finance. Yeah, elementary school teacher, now working in finance. So just give me a second. Let me. Really? Like Newcastle University, Newcastle upon Tyne, not the one in Australia, right? I grew up in Australia when I was younger because my dad was working over there. Give me a second, let me. And then in my university, I studied in Newcastle. Nice. Yeah, the place still looks the same. Actually, it's a lot more crowded now because I just went back there last. So the dean of student for Newcastle's engineering program is actually Singaporean. And then I met him when I was on exchange when during my polytechnic days. So when I was applying for university, I was applying for a local U, and then after that he enticed me to apply for Newcastle University. Oh, it's over here. Yeah. Okay, LifeMD. Let's take a look at the financials. Okay, let me go by quarter. I actually use both because they gave us they had a pretty consistent run of producing free cash flow. But honestly, if you ask me, I think valuation wise for LFMD, multiples is the way to go because they're still so nascent in terms of their profitability, and their free cash flow is actually quite little. So yeah, okay, it's correct. So the numbers actually come down in this most recent quarter. I think I got my dates over there wrong, but yeah. So you can see operating income, net income, both were improving, just turned profitable, but then because of the slowdown, both turned unprofitable again, right? So this is one of those things where you have to pay attention to for the different companies that you invest in, especially the younger companies. Their profitability may not be as sustained, and that is something to watch out for. Grew up in Kenya. Wow. Okay. Yeah, because right now they're trading at nearly 1 time sales debt, which is absolutely ridiculous. Yeah, I'm going to show you from the discounted cash flow. It's actually quite hard to get a valuation because initially I did that because they had a couple of quarters of free cash flow, but yeah, it's not significant enough to actually get any sort of valuation. Okay, so with that, like I was saying, free cash flow might not be the best metric to use for this company. However, I did it just to show you my thought process over here. Now, what I really want to point out is this number over here. Now, usually, I just use the WACC as my discount rate, as in returns that expect the expected returns. Over here, I had to go through the entire model and to actually work out their WACC. Now, you can see over here, my working came up to around 14.7%, but various sources I found online, perhaps they're using a little bit more updated data than what I have. So they got 18.7. I'm going to show you the difference later on. It's not that big. So basically, cost of this is the debt that they have on their balance sheet, which is cost of debt around 5%, effective tax rate. Okay, this one, the cost of equity over here is around 14.9%, risk-free rate 4.3, beta 2.5 over the last 5 years, expected market returns 8.5. So with that, those were the assumptions that I used. Like I said, perhaps some of my data is not as accurate because I tried to dig out from various sources, and the sources online gives me 18.7. If I use 14.7 over here, you can see the price target is around $11.16. Assumption over It's quite simple. The assumption is number one, LifeMD doesn't accelerate growth again. They keep growing at 20% throughout now to the end of the decade. Now, if you believe that, okay, and in terms of their, I forgot to change this. Cash flow margin is fine. It's around 10 to 15%. Have you addressed the healthcare cuts? If you're talking about the refunds, right? Because you're saying the clients cancelled. Yes, the refunds, I addressed that because this was something that I mentioned I was concerned about. If you think about LifeMD, because they work with insurance companies, once the patients get their claims denied, they tend to refund the medication. My concern is that when you compare them to someone like HIMS, HIMS have all these other areas to drive customer growth because they have personalization of drugs. They're able to compound drugs to basically fit a way that you can actually consume the drug. So for certain people, they need the drugs in certain dosages. They need the drugs in certain form factors. They are able to do that. However, with LifeMD, they are not able to do that. And because of that, and LifeMD also signed this GLP-1 agreement with both Eli Lilly and Novo Nordisk. They had to find other ways to expand their business, which is why they probably got into insurance, because this opens up their platform to a wider pool of people. The upside of that is that people with insurance can actually use their platform. Otherwise, with HIMS, they're fully cash pay, if I'm not mistaken. However, the downside is that moving forward, you then have to trust management's ability to guide for the correct revenue. Because this time round, one of the reasons why they actually missed on revenue is because management couldn't account for the number of reads that they have. Yeah, so because of that, that is an inherent risk that they have to take on. And the thing is, the only reason why I'm giving them a slight pass for this is that because they're only a $200 million, $300 million market cap company. When you're a small company, you do what you have to do to survive. I don't think it is actually wise to introduce so much volatility to your revenue number when you're such a young company. But I think you do what you do to have to survive. I'm skewing more to the side of I'm not a big fan of it, but I can understand why they do it, and I can understand the upside of doing it. Yeah, but it does have inherent risk. Whereas, because you have to understand, for a lot of people on Wall Street, a lot of these analysts, they like it when the trend is, very easy to track. It's very easy to model out into their financial models and things like that. And when you add in this layer of uncertainty, it becomes a little bit hard. Additionally, you're a smaller company as well. So there is a reason for that. They do need to be able to expand their serviceable market, but at the same time, that comes with the downside of introducing volatility to their revenue. And I guess you have to, ask yourself whether or not this is something you're willing to accept. All right. So from here, like I said, cash flow, which is why people who tell me, DCF is the best way to look at the companies, I don't agree. I can tell you every single number here guessed. There's no long-term guidance of anything. I'm just using similar numbers to HIMS and then just using that. They may not even get to these levels along the way, right? But I'm just assuming that happens by the end of the decade. And then capex spend, they're quite light on capex, so no problem over here. Now, cash, like they have 36 million cash on hand, debt around 3.4 million. So basically, nearly no debt compared to cash. With this, you will end up getting a share price of around $13.22. Now, EBITDA margin, I use 10% for the very simple reason. Right now, LifeMD is currently around 5.6%. HIMS, even at their scale, they're around 14 to 15%. So if I were to assume 15%, I think it is unfair to HIMS. And it's not as realistic. That's why I use 10%, which is right in between where they are now and where HIMS are. Okay, and then you use a EV to EBITDA multiple of around 10 times. And then, of course, if you assume more, you can. Like I said, I always like to be conservative in terms of the multiple I assign. With that, you get around $14. Now, let's say you want to do 12. I can't remember which company. I think Eli Lilly or Novo Nordisk. One of them was 12. So let's say 12. Even I bring this, it's around $15. I would say a 20% margin of safety is necessary for all the risks that we have stated early on. I think this is the biggest margin of safety I've given compared to some of the other companies that we have done. With that, you get a price target of around $12.27, which is a 98% upside, nearly a double from here. Now, if you tell me, Elijah, you know what? I think 98% upside, double my money, it's pretty good return. Well, I'm going to tell you right now. If all you're looking for is to double your money, there are so many easier plays out there with much less risk, by the way. UNH is a very, very clear example in the same space. And I think they are a much safer play compared to someone like LifeMD. So if you're looking for a double, look towards UNH. If you invest in LifeMD, you have to be in it for the long haul. You have to understand that they are a micro cap company. Because of that, the framework that you use to understand them might be a little bit different. I tend to beg to differ. I feel like if companies are good companies, they should be able to put up the growth even at smaller numbers. I mean, I don't know how many of you actually listened to Andrew Dudham's interview. On the first day when HIMS launched, they had to physically deliver some of the packages because their system broke down or something like that. They had 500 in calls in the first time when they were only expecting 50. So it's things like this that you see the founder mentality. It's so, I don't know. I can't shake the feeling that they are taking LifeMD's management seems to be taking an opportunistic shift to pivot from e-commerce into healthcare, whereas HIMS is always healthcare and let's improve the system. I think Sagik already pointed out LifeMD's business model is more of a distribution channel. HIMS is more, let's try and disrupt the entire healthcare system and revamp it. So HIMS will definitely face a lot more regulatory hurdles. That is the risk that you have to take out. At today's stock prices, would you prefer Oscar or LFMD and why? Can I be very honest? I would prefer Oscar for the very simple reason. I don't think the ACA is going to be, the subsidies are going to end. Like, I think the worry is that the ACA subsidies for Oscar is going to just, you're just going to dive off the cliff at the end of the year. And I don't think that's going to happen. Otherwise, this is where healthcare and politics are so intertwined. I personally, it shouldn't, but we are living in a world where it is, and to just deny it outright is actually not doing ourselves any justice. Correct me if I'm wrong. I'm not in the US right now. I'm just hearing this from a couple of friends that are on the ground. Is it true that in certain states, Republicans are not doing as well as Democrats? Because if that is really true, then all the more I think that there is less likelihood that they are going to cliff. They're basically, I can't remember what's the term that the analysts use, but basically they worry that there's going to be an abrupt cut to the subsidies, and I think the subsidies are going to be basically eased off, right? And they may do it in like, okay, we're going to ease this off in 4 years, and by the time it's supposed to be eased off, you know what? It's the next election, and the administration come in. Whether or not it is a new Republican president who might be a little bit more happy to keep this on, or could there be a change? I don't know. But my point is, I think people are worried about Trump. It's not about Republicans as a whole. It's more about Trump and his volatility. I personally think that you can already hear it in some of the statements. I think I've covered it during my HIMS live stream, that it's quite unlikely because people are already talking to some of the governors, and then already talking to people in the Republican administrations that said, hey, look, cutting all these subsidies now at a time where people are feeling the effects of inflation, you're just going to lose yourself votes. You're going to hurt your own constituencies. Because of that, I think the inherent risk to Oscar is a policy, is a regulation risk. The risk to LifeMD right now could be more structural in nature. because if they cannot get their cost structure right in terms of their acquisition cost for their sexual health department, then that could be that could be a lot more harmful to the company in the long run. I will have to look into Clover. I've never looked in Clover. I know it's one of those Chamath specs, and apart from SoFi, I never really looked into the other Chamath specs. But yeah, so Clover is also in insurance. Ah, right. Okay. Medicare Advantage. That's the one for, if I'm not mistaken, Medicare in the US is for the elderly above 5, private insurance, and the government insurance, right? Something like that. I'll have to look into it. I'm really not too familiar with Clover. I mean, I know about Clover Health, Chamath spec, like I said, but never looked into the fundamentals. But if you say that, you know, they have less risk than Oscar, and then I'm always interested to look into other companies within the same space to understand more. I think especially in the healthcare space, because I'm not from the US, I only use anecdotal experiences from friends that I know on the ground. It's always interesting for me to look into other companies in the space to try and understand it a little bit more, which is why I did UNH, and then as well as Oscar, HIMS, and then now LifeMD. Yeah. Yeah, I know Open. I know SoFi. Oh, yeah, MP. Yep. Okay. So, where was I? All right. So now, if you look at just the price to sales, currently they are trading at around 1 times. Even if they trade at 2 to 3 times, and I don't think that is too far out. If you look at HIMS is currently doing 4 to 5 times price to sales. Now, if you just purely go on that basis, just by multiple expansion, they are able to, give you a 4 or 5x. Now, I'm not sure how many of you are here from, way early on in the channel when I've been talking about how I look at valuation. But people always think about value. I don't know how people think about valuation, but for me, it's basically sentiment multiplied by execution. So for me, I am perfectly fine with the sentiment of the company be as long as the execution of the company is good. Oh yes, so far was IPOE. I'm not too sure about the rest. So what is sentiment? Sentiment is basically your PE ratio, or in this case, your price to sales. And execution is basically your EPS, or in this case, your revenue. So what I'm saying is that sentiment usually tends to lack execution, especially for smaller companies. I think we have seen that with Palantir, we have seen that with Robinhood, we have seen that with SoFi. Time and time again, we are looking for companies that keep executing at a very high level, and eventually sentiment will follow. Just to say that if you apply a 4 to 5 times, if you apply a 10 times multiple to whatever they're doing now, they can be a 10x. But my point, in order to justify the increase in multiple, usually there needs to be sustained execution. Right now, I don't see it in LifeMD. No, that's to say. But like I said, if you want to ask me, fair multiple, 2 to 3 times, I think if they go back to growth, I think that is fairly possible, right? Today, they are trading at $6. If you ask me, can this go back to $12, $14? I think no problem. So personally, for me, although I think that it is more accurate to use a multiples approach, and to me, I think they're fairly valued at around 2 to 3 times sales, which is why I feel like they are better stock than they are a business, because there is inherent risk in the business. But it's also important for us to remember that when we talk about multiples over here, we also have to understand that multiples tend to follow execution unless there's some macro announcements, right? And because of that, right now the execution is a little bit lacking on their front in LifeMD, which is why I think it'll take some time for the sentiment to catch up. But definitely, based on the results that they have shown, I think the 45% drop, was it 45? I think around 45% drop was a little bit too drastic. Yeah. I would say that right now, with this current fundamentals, $8 would make it safe for me. Will be, yeah. And I think if it trades between that range, $8 to $10 for the next couple of quarters until the fundamentals recover, I think it's fair to say that. But I think in order for it to break 10 again and to really get that 2x price to sales or even 3x price to sales, they really have to re-accelerate their growth. Right. But like I said, sentiment can increase, but usually only when execution increase, unless there's some sort of macro events. Okay. So that's why valuation is always a very subjective thing. All right, so finally, let's get into. Oh, you have thousands of Clover, average price $1. How much is Clover trading at today? I really haven't followed that company for such a long time. Okay, then after that, let's go into a framework. Clover Health, CLOV, $2. Oh, wow, okay, that's pretty decent. $2.60, 1.5x. Yeah, I mean, it's definitely something I'll take some time to look into, because I mean, I know they were Chemath spec, and I never really followed the company after that. Yeah. But you know what? I'm fairly interested in healthcare as a sector on a whole over the next. I think it's been way too beaten down. So I think, especially going into a year where there might be a little bit of volatility, yeah, healthcare is a safe place to find certain safe havens, but at the same time, there's still growth opportunities within the sector. So Clover Health, okay, definitely going to have it on my list of to-dos. All right, let's take this through the framework. I'm basically in the midst of adjusting the framework. You're going to see it when I next come online. By the time, I think that's going to be either on Wednesday or Thursday. I will basically be showing you the new framework, and it will be taking some of the old companies through the readjusted framework to account for some of the changes that we have spotted during this week. All right, come, let's take a look at our framework. Okay, so like I said, personally, if you ask me, I think there are a lot of things to like about LifeMD, but there are also that I have concern over. And I think the things that I have concern over, perhaps for those of you who know the company a lot more than me, you are less concerned than me. So I'll be happy, especially if you can leave it down in the comments below, any links or to certain interviews and things like that could answer some of these questions. I will be happy to watch them. So don't leave them in the chat here. Sometimes I may miss them. You can leave them in the comments section later on at the end of the live stream. I will take a look at them, and if there's enough info over there, I will definitely be doing a part 2 to update these thesis over here. I do see inklings of a good company, but my concern, like I said, number 1 is the moat. Number 2 is the ability of management to execute. Right. But I think in terms of the market that they're in, I have no doubt that this is the correct market they're in. I have no doubt that, being a platform in this space as a distribution channel, basically, it's a good market to be in, but you need to be able to defend your share. That's all I'm concerned about. Okay, LifeMD currently $6.19. TEM greater than 10 times of revenue, correct. Okay, 1.5. CAGR more than 10 times. CAGR of the TEM is definitely greater than 10 times. So basically, just to bring you through what I'm going to do in future, I'm not just going to be looking at this. I'm be looking at the 5-year CAGR of revenue as well, right? When I compare with TEM. Okay, simple to explain. Yes, I mean, yeah, simple to explain. Their platform, right? They charge subscriptions, and then they have fees if you buy certain things through their platform. Switching costs, no switching costs. Network effects, definitely, because the network effects is more of, getting the doctors and the practitioners onto their platform, definitely 0.5 over there. Low cost advantage, no low cost advantage. Economies of scale, yes, they do. They are building it out, like I said. Regulatory framework. Like I said, I'm not going to give them a score here for regulatory framework for a very simple reason. They are overly concentrated in certain aspects of their business. Like I think they already demonstrated through their revised guidance that sexual health is an overly concentrated portion of their business, right? Previously, they're growing at nearly 40%, and then with profitability at around $20 million. Then just because of a slowdown in sexual health, while still having that boost from GLP-1s, let's not forget, they actually lowered profitability by so much. At the same time, their growth halved. So you see, in 2023, they grew by 28%. With GLP-1s, they grew at 39%. It was an 11% boost. And then right now, because of these headwinds in the sexuality department for the men's health, they actually decreased their revenue growth to 20%. So to me, I wouldn't give them any thing for moat and regulatory framework. And at the same time, for intangible assets in terms of brands, I think currently you can disagree with me and then your score will be slightly different. I'm giving them a 0. I don't think I can give them points for branding when there's only 200,000 people on their platform. Yeah. I think I need to see a little bit more evidence of people using their and staying on their platform before I feel comfortable giving them a moat over here. Because not only is their member growth declining to 17% year over year, they are facing headwinds in terms of their customer acquisition costs. I need to see this revert back and then continue back to growth, then I feel more comfortable adjusting this number over here. Revenue growth faster than TAM growth, definitely. Okay, no problem. Are they growing faster than actually? They have never grown faster than 30%. Okay, so 5. One dominant revenue stream, this is correct. No customer accounts for more than 10 to 15% of revenue. This one, okay, no customer. What do you consider a customer? GLP-1s are, okay, yeah, I think no customer. Yes, the customers are the patients, right? Not the healthcare providers. High gross margins, increasing stable. Oh, okay, they have high gross margins. That's for sure. Oh, okay. I forgot to talk about this. Operating leverage. Oh, there's no point. Oh, there's no point. There's no way for me to deduct a point here for being overly concentrated. Oh, because they're not okay. Their customer concentration over here is not in a cut, but in a particular healthcare vertical. Okay, let me see how I can score that. I'll just leave that at 1 for now, just to keep the consistency over the last couple of weeks. I will actually model this into the new framework when I'm changing part of this. This was something I thought about. Like we should penalize companies when one segment of their business causes too big a drawdown. Okay, operating leverage over here. I just want you to take a look at this number. Okay, I'm not too sure how many of you read Peter Lynch's book, One Up on Wall Street, but one of the things he actually mentions when he's looking at companies is for companies to be consistently innovating, or he didn't use the word innovating, developing new products. Okay, developing products. Now, for me, how I represent that is actually, oh, it's not here. Oh, right. You know what? I really need to upgrade my version of Fiscal AI too. Oh, it's here. But I do. Okay. And then I just want to show you total revenues. Okay, what you're seeing over here in this screen is the revenues that are being generated by LifeMD compared to the amount that is being spent on R&D. Usually a comfortable amount will be close to around 8 to 10%. Currently, they're doing closer to, maybe 4%. bit less than that. Yeah, around 4%, I would say. And HIMS, for their scale, they're currently investing around 8% of their revenue in R&D. So for LifeMD, not only are they, having to struggle with their cost acquisition issues, now they're also not able to invest as much into R&D as HIMS, which is why, to me, the gap in terms of their technology is going to get wider and wider, because on an absolute number basis and on a percentage basis, HIMS is reinvesting more than them to develop new products, to develop new systems. So this number has to increase while the rest of the numbers are decreasing. And if you take a look over here, this is rather concerning to me. Where is Okay, let me remove the research and development. This is their SG&A. It has been increasing consistently over the last couple of quarters. So SG&A increasing while not investing much in R&D, to me, it's not something I want to see in my company. I want to see SG&A flat and then increasing investments in R&D. So this is something I am taking points off because to me, part of my framework, I try and model it very closely to Peter Lynch's book, One Up on Wall Street. And this is one of the things that he looks for when he's looking for potential multi-bagger companies. Okay, so with that, let's go back to... So if any of you are not sure why I made certain decisions, feel free to ask in the comments below. But generally, I base it on One Up on Wall Street. A little bit, if you read Black Swan and Anti-Fragile by Nassim, that's the last part over here about risk management. So some right now, I would say inconsistent cost control, inconsistent cost control, right? Or high fixed cost. I don't think it's a given that their fixed costs are high. I think right now it's just inconsistent cost control. You can see SG&A high, and they are spending less on R&D. Not what I want to see. Okay, debt management, no problems over here. Goodwill less than 30%. They got no goodwill, if I'm not mistaken. And then they are positive free cash flow and growing. Okay. You see, the free cash flow is so low, it's so inconsequential. I think everything is contextual, right? You can say that yes, they're positive and growing, but their free cash flow is so inconsequential, and it feels like a cover up for, it feels like to distract investors. Oh, I struggled with this for very long. I know he's the founder, but he wasn't the founder. Technically, he's not the founder of... Okay, he is the founder of LifeMD by virtue of being the one that founded Conversion Labs. I am definitely taking points away for this. Personally, not convinced, but I mean, I've listened to so many CEOs speak. I've spoken with people who owns their own businesses. Not convinced by the way he talks. Like I said, open to changing my opinion around him, but not convinced at the moment. Initially, I was really tempted to go with this, but I think this is a little bit too much. But to me, it is a poor track record. You know why? E-commerce did so well, but they didn't do well enough, and then they have to pivot into healthcare. So that's my take. I've said it. I hope proven wrong, but yeah, I don't know. I'll be fair. I'll give 0.5. Okay. In my heart, I want to give 0, but you know what? I'll be fair, 0.5. Okay, high insider ownerships, yes, no buybacks. Reducing debt, they have done that. Low to no risk. Exit unprofitable segments. They have no unprofitable segments, right? Yeah, so I don't think so. Improve liquidity, no unnecessary M&A. Yeah. Core business can survive downturns. Okay, suffers in downturns, right? We have already seen core business suffers in downturns. It's not even a downturn, it's just CAC. and their business less than 5 years. Okay. So I think this score is exactly what I would describe them, weak or in transition, and they are in transition. And that's not to say that, you see, the thing is, all these frameworks, I'm sure there are other content creators out there developing their own frameworks. This framework only does well to show you where the company is now. In order for you to make this into a good investment, the valuations have to be right. The story is something you have to believe in. And these two things cannot be accurately represented in every single framework. You have to understand, no matter what framework people show you, it is some words and numbers that they put into an Excel file that has worked for them previously, which is essentially what is my framework. I like Palantir, I like SoFi, I like Robinhood, I like HIMS, and I try to look at what are the common things I saw in these companies, and I try to put them into a certain framework that I can use numbers to actually visualize. That's all. So to say that, oh, because this is weak or in transition is not investable, not necessarily the case. You have to understand that when as businesses go through different parts of the business cycles, there will be time that they are weak or in transition, which is why they are still a micro cap company or a small cap company. But eventually, if you can see the other side of the story, if you can see the execution taking place, then perhaps then perhaps this doesn't mean that it is completely uninvestable. Now, for me, for my investing style, this doesn't work for me. Grab, yes. Oh, I have something to say about that later on. Yeah. No, and I think it's always interesting for me to look at these companies in the US. To me, it doesn't really matter whether or not the analysis end up with a high quality or story driven, weak or intrusion or don't touch, which is less than 15. You can see over here the score is actually pretty close to being a story company. So I think just some things need to change. For me, I can't get over the discomfort of the pivoting. I just need, so because they pivot in the matter of 3 years, I think I need to see a little bit more from management to know that this is really a trajectory that they are going to continue for a long period of time. I'm going to need to see changes around their member growth and revenue growth. I need to see them both trend back in the right direction, because I am not seeing the same macro trends in other companies, right? And I think if you are looking at it at a valuation play, definitely, I think one-time sales, no matter how bad they are, this is ridiculous to be trading at one-time sales. So like I said, the valuation makes sense. You have to believe the story. Otherwise, that's why if I look at this, to me, we in transition, more or less, is where they are, or where I would say they are. Yep. I'm in this stock for huge TAM. I'm having an alternative to HIMS. Yeah. I think this is not a either or. It's not a. I think a lot of people like to make their. I think maybe for the headlines, maybe for the engagement or X, it's always a binary decision, right? Either HIMS or LifeMD. I think both can work out at the same time. And if no one else comes into this space, LifeMD can have a very successful platform and a very strong distribution channel. And I think a lot of small businesses, we see them for what they are right now, which is a distribution channel, but you never know how they can grow. And I think the CEO needs to be able to paint that bigger picture for investors going forward. Yeah. Just a couple of things before I bring this to a close. Now, I am not sure. Okay, first things first. There's been a lot of changes recently in my uploading schedule. I've been uploading consistently one video a week for the entire year, since May of 2024 all the way to May of 2025. Now, I believe most of you found this channel sometime around July and August, if you did, right? Because I started pivoting from just personal finance content into more, like individual stock content, because this is something I enjoy more than talking about, how much miles you can get from credit card and things like that. I'm not a personal big believer in those sort of things. I just use that to practice like uploading video. Now, I have managed to, thankfully, in the last couple of months, adjust my financials and say that I have 1 foot out of my work right now, maybe 1.5 foot out. So I don't have to be so, I don't really have to go back to work. I've decided not to completely leave my company due to certain clients that I have a close relationship with. Then I'm basically, I think, out of responsibility to them until they decide, at such a time to leave the company. Then I'll leave completely. But until then, I decided to stay on to help manage some of their portfolios and things like that. But yeah, I'm not going to be spending too much time in my 9 to 5, so I'm going to spend more time over here. Now, with that, what that means going forward is that things are going to change around here. It's no longer going to be one video a week. I have an idea of what I want to do in mind. I'm going to put it out there now. I don't foresee there to be major changes from what I'm putting out today. Yeah. So let me zoom this in so I can type this out. So basically, you see the only thing, right, is like our time difference is huge. So I need to bear in mind Monday, it's going to be Monday, Tuesday, Friday. So what I hope to do is to stream daily, at least an hour. These are going to be daily streams. I would say market open. Reason is to go through my portfolio. I've shown you like certain screenshots, certain snippets here and there of the portfolio, but I've done it in detail. And the reason for that is because over the last couple of years, previously, I had like when I first started investing, I only started with about 120,000. And then after that, I lost about 30,000 of, okay, you know what? I have doubled that money and lost the doubling of that money many times because nobody taught me investing when I was in Singapore. I was a teacher by training, engineer by training. I tried everything myself. So every stupid mistake you can think of, margin call, done. YOLO into 0-day options, done. Doubled down into options and not understanding IV and things like that, done. So everything. So as much as I have picked companies like Palantir and SoFi, I have also lost like at least a good $100,000 to $150,000 as well. And I've been trying out all these things so that I get to a point where I know what works, what doesn't work. The past year or so, I've managed 2 portfolios, 3 actually. One of them, I will show it next time, is around a $20,000 portfolio. Grew that to $50,000, and then I stopped because that was 1 year. And then using a more buy and hold longer term approach strategy, managed another portfolio, grew that from 70,000 to today. I think it's 140. Oh, I can show you. That's the Momo account. I believe the Momo account is not accurate. For the very simple reason, I remember topping up around $10,000 recently. But the reason why this Momo account is still here is because my dad wants to learn how to do these kind of things. So I just leave the account there for him to use occasionally. Let me show you. Okay. So this is the account I'm talking about. I think some of you have seen this account before. This is the account where I have my Palantir with a cost basis of negative $200. So I did have this account. This account started with over 70,000. I can't remember what this account started with, to be honest. Where does it? I haven't used their product in a long time. Time weighted. Yeah. Okay, year to date, you can see we're up 26,000. 25%, which is, yeah, better than the indexes. So this portfolio takes a more conservative approach. I haven't really been selling so much. So what happened is that recently I've decided to combine some of my savings, my investments, and things like that into one big portfolio, which is the one that you've been seeing on Webull. We started off with around 520,000. Currently, it is sitting at around 610,000. That's after withdrawing around $60,000 in profit recently for my parents' retirement. So now I basically only have two portfolios, the Webull one and this one, and that is going to be what it is for now. And what I'm going to be hoping to do is that every single day I'll come on, I'll talk about what I'm thinking about the markets, my thought process behind some of the moves I'm going to make. I think it's also an accountability for me when I make certain moves in the market. I think in the past I've been a little bit haphazard. So like I know how it works, I know what's happening in my head, but I never ever document it down. So when people ask me about it, sometimes it's a little bit hard for me to repeat it. So I feel I think I was struggling with this for the longest time, because do you show your net worth? Do you not show your investment accounts and things like that? I think, in all honesty, I'm always afraid that, once people see it, there will come a time where you will buy certain stocks or sell certain stocks and people will just copy you without understanding why, just because they think you have more money than them, and then, it might be a wrong move, and then things like that. People don't learn. But at the same time, I also think that, nowadays with AI and things like that, it's so easy to just manipulate a screenshot. So I feel like unless you can give credibility to what you say by actually talking through your thought process and showing everything, it's quite hard to gain credibility, I feel. Right. So, and it's very easy to say that, oh, I've put 1% of my $1,000, $10,000 into a position, and it feels big to you. But if your portfolio is $50,000 and mine is $600,000, $10,000 to me is a small swing trade. But for a $50,000 portfolio, $10,000 is actually 20% of your portfolio. So I think that is, in the end, I decided for now I'm fairly comfortable with sharing what I'm doing with my portfolio, and then we'll see how that goes. So that will be the daily streams. Now, I know on Monday, for those of you who have been, if you are like me, the reason why you're here in the first place is you have followed certain SoFi content, or perhaps you have followed Amit's content. On Monday, they have the old Robinhood Weekly, and on Friday, they have the old Palantir Weekly and the old SoFi Weekly. Right now, what I plan to do is to slot myself right in between, at least twice a week on Tuesday and Thursday nights for you guys. Okay, so this is where it gets a little bit complicated. For people who are in the US on Tuesday nights and Thursday nights, there are going to be 2 streams every week, around 9. And the purpose of these streams, number one, it's going to be, just so happens, okay, it's a quite, pardon me for the lame puns, but SG Weekly. SG Weekly stands for, it can be Singapore, yes, but it can also be C Limited and Grab, the 2 Singaporean companies. Just so happens they work out nicely to be SG Weekly. I'm going to be covering these companies because I know there's a huge interest on these 2 companies. And I think it's similarly, it's like when Singaporeans want to invest in the US companies, we find it a little bit hard to get information and things like that. And then I think similarly, when people try and understand all these companies in Southeast Asia, it's a little bit hard to understand the dynamics over here. And so that's why I wanted to try and help to plug the gap. So that's the first thing. And then the second thing, what I hope to do on Tuesdays then will then be to conduct research online live for you, so that what I've been doing in a live stream, I've already prepared most of the research beforehand, and then I'm just presenting it to you on the live stream. What I hope to do eventually is that I will prep all the resources, but I will not read through them. So I will go through them with you live on stream. You can see how I actually look at the things, and then how we put together the framework, how we put together the valuation, everything step by step. I'll be showing you every single week, right? And the reason for that is so that at the end of that stream, perhaps the last 15 to 20 minutes, I'll use that stream to present all that info in a very concise manner. That 15-20 minutes will be repurposed as a video later on for people who are not able to stay through the whole stream and you just want to watch the conclusion to that stream. Okay, so with that, like I said, daily 1 hour market open, and then twice weekly, one for researching and one for weekly. We'll see how that goes first with that schedule, and hopefully with that, I'll be able to at least post consistently in terms of live streams, and then in terms of actual videos per week, at least hoping to do 1 to 2 videos a week. Right. So with that, I think we have come to the end of the live stream. Thank you, everybody, for being here. I've taken up 2.5 hours of your Labor Day, so I think it's time that you go and spend that with your family and friends. And for people in Singapore, I think it's time to sleep. It's 1 a.m. I'm actually heading to the gym, but yeah, I don't have any work tomorrow, so that's fine. All right, see you guys. Ciao.